Good morning, everyone. I'm John Kogan, CEO of Proformative, the online community for corporate finance, accounting, treasury, and related professionals. I would like to welcome everyone to the webinar entitled Revenue Recognition, Regulatory Update, and Best Practices. There have been many far-reaching changes in the area of revenue recognition, especially for multi-element arrangements and for certain hardware and software combinations. A lot of companies will be affected by these new regulations. A lot of companies actually already have been affected by these new regulations. And we are happy to have you with us here today to learn more about the changes and what is coming down the path towards us in the form of new regulations. We won't be able to cover all of the issues today in full depth, but we want to lay out the basics at this point so you can at least ground yourself in the current regs and determine where you may need to learn and do more to prepare. I would like to thank our sponsors for today, PricewaterhouseCoopers, NetSuite, and Host Analytics, for helping us make this event possible and available to all of today's attendees free of charge. A quick note on today's agenda. First, we will hear brief presentations from two speakers. There will be a regulatory overview from Aaron Victorino at PricewaterhouseCoopers, and then there will be an sort of experiential overview from Paul Turner at NetSuite, talking about their adoption of these new RevRec regulations. Each of these presentations will run about 20 minutes, and then we will move to a panel discussion where we will spend the remainder of our time. We would like this to be an interactive experience for you, so if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your questions. So if you see the little control panel on the screen, there's a section there called questions, and you can expand that and just ask your questions. We'll queue them up, and then we'll do our best to get to them when we get to the Q&A period. We can't promise to get through all of them, but we will do our best to hit as many as we possibly can. We will be sending out soft copies of this presentation to all attendees, so please take a look in the next 24 hours. You should be getting an email with that. There are a number of folks I know who are signed up for CPE credits for today's events, and we are happy to provide those to you. If you have any questions at all about CPE credits for this event, then please contact Tanya Walsh. That's TWALSH at Proformative.com. She handles all of our CPE credits. She'll be happy to help you out. Also, a quick note for those receiving CPE credits, we will have two quick polling questions. So we're going to go through the first brief presentation, do a quick polling question that'll take about 30-45 seconds. Then we'll go through the second presentation, another quick polling question. That's simply a requirement of the organization that allows us to grant CPE credits for these events. We need to have those polling questions to make sure the CPE recipients are paying attention. So for those not getting CPE credits, apologies for that, but it will be brief. So with that preamble, I'd like to go ahead and get us right into the content for today. And to lead us off, I'd like to introduce Aaron Victorino, who's a director of the Transaction Services Group at PricewaterhouseCoopers. Aaron specializes in the technology industry. He's delivered technical accounting and financial reporting advice to large domestic and foreign SEC registrants under both U.S. GAAP and IFRS in connection with SEC registrations, capital markets activities, IFRS conversions, and M&A in the U.S., Europe, and Asia. Aaron has technical expertise in revenue recognition, stock-based compensation, intangibles, and business combinations. And I'd like to go ahead and hand the slides over to Aaron to get us started. Aaron, please take it away.
Well, thank you, John, and thank you for inviting me back to speak today. So as John mentioned, my name is Aaron Victorino. I'm a director at PricewaterhouseCoopers, and so as anyone knows who has spent any time applying the GAAP guidance on revenue recognition, these rules can be voluminous and complex, and oftentimes the model applied and the timing of revenue that results can come down to questions as to whether or not the relevant guidance is scoped within the industry-specific guidance that applies to specific industries, such as, for example, software, or even guidance that may pertain to specific types of transactions, such as long-term contracts or extended warranties. So today I'll share some of the changes that, as John mentioned, have become effective in the last year that came from the EITF. And I'll cover some of the challenges and opportunities that companies have seen at a high level with focusing on key impacts from an operational perspective. And then I'll also discuss briefly some of the changes that we expect to come from the joint project that's currently underway on revenue recognition from the FASB and the IASB. So first off, how did we get to where we are today? So in 2009, the FASB issued 2 EITFs that relate to revenue recognition, intended to deal with a couple of issues that are especially relevant to tech companies. So historically, these there were really perceived to be 2 key issues that these EITFs were intended to address. So first of all, the scope of the software guidance was fairly broad due to the scope of the software guidance, and specifically, unless software is incidental, companies that may have not generally or traditionally thought of themselves as software companies may have ended up scoped into the software revenue guidance. One of the second challenges historically perceived was that the bar to establish fair value for multiple element arrangements was fairly high, and so as a result, a lot of companies that didn't think of themselves as software companies may have found themselves historically deferring revenue for a product simply because they were unable to establish vendor-specific objective evidence. A good example of this is Apple, who sold the iPhone, which is considered to be a hardware device, but it has software to run it, and they provide updates and upgrades to that software. And so, since they weren't selling those updates and upgrades separately, they were not able to establish this bar of fair value, referred to as vendor-specific objective evidence. And so as a result, they were having to defer all the revenue for the iPhone and recognize that over a 2-year period. So often companies felt that this model resulted in revenue recognition that did not reflect the economics of the arrangement. So to address this, the boards with these 2 EITFs did 2 things. First, they changed the scope of the software rules to exclude many products that are not traditional software products. And secondly, they allowed companies to use something called best estimate of selling price in the event that a company was not able to establish this vendor-specific objective evidence or third-party evidence. To the extent that those measures were not available, the boards allowed companies to use their best estimate of the selling price for the individual elements. And this had effects even outside the software industry, such as biotech, for example, where the bar was still set fairly high under the historical rules. And so, as well as doing those 2 things, changing the scope of the software rules and adding best estimate of selling price, the boards also eliminated the residual method as a means of allocating revenue to deliverables. So this had several effects for companies that sell products in multiple element arrangements. You can take Cisco as an example, and Apple in particular, that are good examples of this. In general, in terms of the opportunities and challenges, and starting with the opportunities, in general, this was pretty good news for the business. I say that because we like to say that accounting follows business and doesn't drive the business. I think in the past, however, we had seen that business practices have been constrained by the accounting rules, and these new rules offer some flexibility to structure arrangements and for companies to go to market in a way that makes more sense for the business as a whole. And as much as we say that accounting should follow the business, the higher bar of the old rules often had the effect of restricting the company's practices. So these new rules offer some flexibility on what I'll call the front end of the business. Now on the back end, we have seen some challenges that companies deal with. So the greater use of judgment offered by, for example, best estimate of selling price presents some challenges in ensuring consistency of application in particular. So we've seen companies spend some time to develop and operationalize policies and procedures to determine the best estimate of selling price, and as well to make sure that that's auditable and it stands up to the scrutiny of 404 and the auditors that and the effort of the auditors to make that auditable. So companies have spent some time to ensure that they have defined processes and controls and make sure there's sufficient contemporaneous documentation in particular to support management's judgments and estimates in that area. As far as other challenges that we've seen companies deal with, as well as changes to accounting systems, as well as changes to the policies, there have been changes to accounting systems as well, which have evolved to handle residual value historically. The systems historically had evolved to handle residual value nicely, given the fact that residual value goes away. This presents some challenges to the configuration and data needs of those systems. So companies can still find themselves with transactions even under these new rules that fall partially within software rules and partially out of software rules, which I'll touch on in just a few moments with an example as well. And this can create complexity because companies then need to systematize the application of two different models potentially using the residual value method as well as this new, the new best estimate of selling price that the boards have allowed here. And so in addition, companies have needed to focus not just on historical impacts, but also, what does this do to forecasts and financial models, as well as the structure of commission plans, for example, for the sales force. So there are other operational impacts as well that companies have worked through. So just to kind of illustrate the impact of the new rules that have become applicable in this last year for companies, can walk through an example here actually. So the assumptions, starting with an example here where a company sells a system including equipment and automation software, for example. And this automation software is always included when the company sells the equipment. The sale includes a 3 to 5 year maintenance agreement to support the software and the equipment itself. And VSOE does not exist for that maintenance in this example. So prior to the application of these two accounting standards updates, since software was more than incidental, the revenue for the whole system would have been scoped into the software rules under SOP 97.2. And since in this case VSOE, the vendor-specific objective evidence measure, does not exist for maintenance, all revenue would have to be deferred and recognized over the maintenance period because it didn't meet the definition of a separate unit of accounting. As a result of the application of these two accounting standards updates, because the automation software is always included under the new guidance, it is deemed to be essential to the equipment's functionality, and so the system and the software is scoped out of the software guidance. It is not considered a software deliverable. Allocation between the delivered and undelivered elements is governed by the new guidance of ASU 2009-13, which requires relative standalone selling prices. And if VSOE does not exist, which it does not in this case for the maintenance, management has more flexibility to use what we refer to as third-party evidence or best estimate of standalone selling prices, and recognize revenue for the equipment, hardware, and the automation software up front, and then defer some piece of that revenue for the maintenance. So to kind of give an example of the economic effects of this, may reflect the economics of the arrangement better. Instead of having to, say, defer $1 million of revenue over the 3-year maintenance period, the company may be in a position of being able to separate those and recognize $800,000 upon delivery, and then the $200,000 for just the maintenance piece over the 3 years, which companies may feel reflects the economics of the arrangement better. So I mentioned earlier that some companies may find themselves in a mixed model, and this here is a somewhat busy slide once I get through the animations, but it kind of illustrates how that might happen. And so, here's an example. The example I walked through earlier had just a piece of hardware with software that was essential. And so all of the transaction was scoped out of the software rules of SOP 97.2. However, we have seen circumstances where a company may sell hardware with essential software, which is always provided with that hardware, in addition to which the company may offer software-only options. And so a customer can select, say, option X, Y, and Z, which are only enabled in software. They don't come with any additional hardware. They are not always provided with the hardware, and so they're considered not essential. And then some complexity may arise because the company may actually offer support arrangements or maintenance arrangements that cover both the hardware and the essential software, as well as support for the optional software. And in these cases, we can see a little bit of complexity here, and you can start to see how a system might start to grapple with this a little bit, might start to struggle with this a little bit, where the first allocation, there's actually 3 allocations that need to take place here. The first allocation is to separate the piece that is scoped into software rules and outside of software rules. So that's the first T-bar here, where there's a relative fair value allocation between the pieces that are scoped in and out of software rules. Following down the right, for just the software-specific piece, so the optional software and the support that relates to that optional software, there is an SOP that the piece of the arrangement is scoped into SOP 97.2, and so the company must be able to establish vendor-specific objective evidence, that higher bar for fair value for the undelivered piece of that, the support of the optional software. So that second T-bar there, the split between the delivered and undelivered, would use the model prescribed by the software guidance still, which is generally a residual value method, because the company probably does not sell that optional software separately, and would only have potentially renewal terms or other standalone sales of the support in order to be able to do the allocation for just the software components. So that's you're still using a residual value method on that side, needing to establish vendor-specific objective evidence. On the other side of the arrangement here, with the piece of the sale and the hardware and the essential software that is scoped out of the software revenue rules, there is now a relative fair value allocation that is done under the new guidance of 081, which is that ASU 2009-13, where the residual value method is not allowed if the company does not have vendor-specific objective evidence, then it may be able to use a best estimate of selling price. And some complexity can be introduced here as well. If the support contract is really one arrangement, then it may not necessarily call out specifically the support that relates specifically to the essential software and the support piece that relates only to the optional software, and so there can be some complexity in separating those. And so a system that needs to deal with this would need to understand the difference of what's in or out of the software rules, understand how to apply a residual value method using vendor-specific objective evidence, and then also how to apply just to the piece that's out of the software rules a relative fair value incorporating either vendor-specific objective evidence, or if that does not exist, then best estimate of selling price. And so we've seen some complexity around this as companies work through this model. So that's a rundown of what we've seen in the last year, some of the changes that have come through and challenges that companies have undergone and opportunities as well as they go through some of the changes that have come through in the last year, and that's kind of where we stand today. One of the things I wanted to share as well is a preview of some of the new guidance that's coming in the FASB and IASB's joint project on revenue recognition. Those EITFs I talked about are already out there. They are already effective for companies currently, and this is intended now to be a preview of some of the changes that are expected to come down the road in the next couple of years. So as background on this project, we actually about 6 months ago would have expected to see a final draft or a final document by this time. This has actually been a long-standing project It's a joint project between the FASB in the U.S. and the FASB's counterpart in the UK, called the IASB. This has been a joint project since 2002 to replace all of the roughly 200 pieces of revenue guidance under U.S. GAAP and the 6 pieces of guidance under IFRS with one converged standard that would cover software arrangements and as well as non-software arrangements. So this distinction between software and non-software would go away under this proposed standard and would just be covered by one standard. So the intent is to apply this one standard across all industries, all transaction types, regardless of whether it's software or non-software, a long-term contract or extended warranties. They would all be covered by this one revenue standard. So the boards have been deliberating that since 2002. They did issue a discussion paper in 2008 and an exposure draft in 2010. The comment letter deadline completed. There were over 900 comment letters received last year, which gives you kind of a sense of the level of interest in this project. We're generally not used to seeing more than maybe 200 or 300 comment letters on a project if it's maybe 300 if it's a particularly contentious or interesting project. This one received over 900, so clearly a project that most companies feel will have broad impact. The final standard was originally expected to be issued in June. The boards went through the redeliberation process, considering all of the input in the comment letters, and have come up with tentative decisions on many of the points that were addressed in those comment letters, and decided to, instead of issuing a final standard in June, decided instead to extend the deadline and re-expose a proposed standard. So we were expecting actually to have that in September. We're a couple weeks now into October, so it's due any day now to get this re-exposure. The plan is to allow a 120-day comment period on that, which puts us into 2012. And then the boards would redeliberate the comments received from that and issue a final standard expected now sometime in 2012. So that's kind of the overall timeline and the expected application. As far as the effective date, the boards haven't specifically discussed this, but it would be expected to be sometime in 2014, 2015 at the earliest. So the core principle here, as I mentioned, is it's applicable to all entities and industries and would apply to contracts with specific exceptions. Lease contracts, for example, would fall under the new lease project and would not fall under this project here. As far as a couple of the features of the proposed model and some common questions that are arising. And, of course, maybe preface this by just saying that, we would expect that there will be more clarity on these as we get the exposure draft. Of course, if folks like myself follow the redeliberations pretty closely, we will, of course, as I mentioned earlier, see a re-exposure of this proposal and then, of course, comments on that. So, many of these are still in motion. But the proposed model contains 5 basic steps and then some other guidance on particular types of transactions. Identifying the contract with the customer is the first step, and some of the questions that arise here are how are enforceable rights and obligations created when in the company's customary practice. Those could be written or verbal arrangements. And then the combination of contracts. There's new guidance in this model that can look similar to today's guidance, but in some cases, in some nuanced cases, can create differences. As far as identifying within that contract, the next step is to identify and separate the performance obligations in that contract, and that relates specifically to explicit and implicit performance obligations. And so this really kind of puts the focus on companies that are doing their contract reviews to ensure that they really are identifying those explicit and implicit performance obligations under the contract. As far as separating those performance obligations and treating them separately, The criteria is to actually use distinct, to separate distinct performance obligations under the arrangement and treat those separately. And there's guidance within the standard as to how performance obligations would be considered distinct. What is the definition of distinct? But distinct performance obligations under the contract would be required to be treated separately. So companies would need to consider things like future free or discounted goods or services. For example, service type warranty as well, which is kind of somewhat akin to what we think of today as extended warranty, and other stand-ready obligations such as post-contract support, as well as implicit promises. So once the contract's been identified, distinct performance obligations have been identified within that contract, then the next step is to determine the transaction price. And there are some nuances here, around, especially around the idea of variable consideration, where companies have, for example, tiered pricing or performance fees or other types of arrangements that can create variable consideration. The company may need to reasonably estimate those. There may be a requirement to estimate those to the extent that the receipt of them is reasonably assured. And that can create some complexity in how companies recognize revenue today. As well as collectability, and this is one that's kind of gone back and forth and is still a bit of a moving target. Under the current redeliberations, and this is a bit of a headline here, that collectability is no longer outside of revenue. So if you have a concern about the collectability on a contract to a customer, the adjustment to the amounts collected actually impact revenue rather than impacting something below revenue, such as a bad debt expense in operating expenses. Those actually become part of revenue. And as I mentioned, that's something that was in the original exposure draft, has been redeliberated now, and may continue to evolve as we get comments on that proposal. The allocation of the transaction price between the performance obligations is similar to what we've seen today under 081. For companies that are applying software rules, this may be a change as well, and has continued to evolve. The boards are talking about residual value as well, but there are complexities in how you would allocate revenue between the various performance obligations that can impact the timing of revenue. And then the revenue for each of those performance obligations is recognized as those performance obligations are satisfied, which the boards are now looking at two models, one for goods and one for services. For companies that are licensing software, you would need to actually apply either the model of goods or services, depending on how the license is structured. So that can create some complexity as well. So that, at a very high level, is the proposed model. Without getting into a lot of detail on that, some of the challenges and some of the changes that are coming down the road, and of course, as I mentioned, there will be we'll expect to see more clarity on that as we get a re-exposure of that proposed standard. And with that, John, I will hand it back to you.
Thank you, Aaron. Boy, if there's ever been a clearer case of guaranteed employment for folks in the accounting profession, I haven't seen it. That looks complex and getting more complex. That's true, and it'll take a couple of years as well. Yeah, to shake out. So from 2002, maybe until 2015. Wow. Okay, and a quick question. Does EITF 081 completely replace 0021?
No, it does not. That's a good question. It replaces the portion of 0021 that addressed separating and identifying the separable accounting units, separate units of account. So so other aspects of 0021 that remain, for example, are the paragraph 14. For companies that apply the cash limit requirement of 0021, that remains. So there are other aspects of 0021 that are not affected by 081. But 081 does eliminate the use of the residual value method and allow companies to use best estimate of selling price when that's available.
Fantastic. Well, I've actually just opened our polling question, and let's just take care of that really quickly. And once again, this is not something that's supposed to be tripping folks up. It's We're here to make sure that you're actually online and paying attention for CPE credit. Those who are not interested in receiving CPE credit, feel free to ignore the polling question. We'll leave this out for another 10 seconds or so, and then we will go ahead and move on to the next speaker. Wonderful. I think that just about does us on that one. Let's go ahead and keep going. At this point, I would like to introduce our next speaker, Paul Turner, Senior Director at NetSuite. Paul has implemented and defined strategy for financial software applications for the past 15 years in senior strategy and software implementation roles. Paul is currently a Senior Director at NetSuite. Prior to NetSuite at Hyperion, which is now part of Oracle, he was responsible for its financial consolidation, budgeting, planning, and BI technology strategy and roadmap. He's also worked on a number of financial planning and analytics and reporting implementations at Fortune 500 and smaller companies. And Paul was a central figure in NetSuite's 08-1 RevRec implementation process. And he's here to tell us a little bit about that process and what they've learned as a public filer, having gone through this not-so-simple process of conversion. Paul, please take it from here.
Thanks very much, John. I hope everyone was listening to Aaron's answer on the 021 to 0801 prior to the poll question. So yeah, actually the plan today actually is I'm thinking through kind of a broad overview actually of NetSuite's revenue recognition process. So everything from the sales order all the way through to our reporting. So just give you kind of an inside look at how we treat revenue recognition, some of our processes, some of the controls that we have internally. As John mentioned, NetSuite's a public company, so I'm just going to kick it off and give you a little background on NetSuite. One of the things we really focused on is making sure that our revenue recognition kind of scales up. For example, we're a very fast-growing company. We're actually one of the fastest-growing kind of cloud business application providers, and so things like spreadsheet-based processes for 0801 really is not a scalable option for us. So we made sure, for example, with our 0801 option, that it was as automated as possible and driven down into the ERP as much as possible. So I'm trying to kind of wean ourselves off of spreadsheets, which is kind of dangerously easy to end up in kind of spreadsheet hell with 0801. So just another little background on NetSuite. So if you're not familiar with us, we were founded in 1998 by Larry Ellison, CEO of Oracle, and Evan Goldberg, the current CTO. As John mentioned, we're a public company, traded on the NYSE, went public in 2007. We have just shy of $200 million in revenue and about 1,200 employees internationally. And a substantial amount of our revenue is recurring revenue. So we offer a subscription-based solution. So it's a pay-as-you-go, cloud-based solution. So our revenue really breaks down as a combination of subscription-based kind of recurring revenue and then kind of implementation services. And we have about 7,000 customers globally. So kind of moving on to our revenue environment. Actually, it's a little bit out of date. Actually, I think we're about 1,500 orders a month right now. But in terms of the kind of our revenue environment, so one kind of point I'd like to make here is that we've integrated the entire process with our revenue recognition. So everything from a sales opportunity when it converts to an estimate, all the way through to a sales order, and then revenue recognition, invoicing, that's one integrated process. And so we've gained a lot of efficiencies and synergies around doing that. We have multiple kinds of business that we book. So it's everything from a net new sale all the way through to an upsell, and obviously we're a renewals-based business as well, so a lot of contract renewals and renewal sales team. In terms of our revenue, it's a combination of subscription, so we have a monthly subscription, support tiers, as well as professional services, and about 300 items broken across the 8 or so currencies. In terms of our revenue recognition, so we, as John mentioned, we moved to EATF 0801. Obviously, customers can't take delivery of our software, and then we maintain all of the estimated selling prices centrally within our ERP system. So with our professional services, we've actually integrated up, we have an integrated project accounting solution that we use, NetSuite OpenAir, plugged into our ERP, and so we actually, our PS revenue, that's recognized in terms of a % complete, and then obviously our subscription revenue, we spread that over the term of the contract. So just kind of like take you through our overall process. So we actually have kind of controls in place, starting with the sales order. So we actually have a checklist, and I'll take you through a screenshot of how that looks like. We've actually baked a checklist into the sales order, and what happens is, as soon as the sales order is entered, basically then our finance team will basically log in, review the sales order, and then fill out the checklist, and all the checklist is stored centrally. Okay, so that's an order flow checklist, mapped to each sales order. And I'll drill that in a moment. Then in terms of the, we then move to kind of the allocation and revenue recognition schedule management. So we've automated the process of identifying whether it's a single element or a multi-element contract. If it's a multi-element contract, we then go through the actual allocation process. So based on the item type, we'll then basically drive the ESP allocation, and then also then map the relative allocated ESP items to the relevant revenue recognition schedule. We've kind of automated the revenue reporting because we report straight off our ERP systems. We don't typically use spreadsheets for reporting on the revenue reporting side of things. So we break out by customers, by items, by item type, and we basically report in real time from our ERP system. One of the things we've actually done in terms of 0801 is we actually have ESP monitoring as well. So we actually have threshold-based monitoring in terms of the allocated ESP amounts versus the pricing on the items, and we actually have a threshold. So we're looking within 5-10%, for example, to make sure that our ESPs are set accurately, and then we run through and then review and then reset them as required. And then I'm taking you a little bit through our revenue forecasting process. Now, one key takeaway here is that, let's say, everything from the sales order through to the invoice with our internal systems, through to the revenue recognition schedule, the way through the journal entry and the GL, we're actually running on one single system for that. So all of our CRM system and our ERP system are all basically completely linked on one system. That makes it much easier. We don't have to go through reconciliations and kind of hunting down the sales order, for example, in a separate system. All of it is baked onto a kind of single customer record. So that makes it much easier in terms of audit time, as well as it makes it much easier for management reporting, financial reporting, all that stuff, because it's all in one single location. That's one of the big benefits in terms of us being able to scale up as our order volume increases. We've got everything running in one single location. So just kind of jumping into the start of the process, the sales order management process. So we actually have an offshore team of CPAs that we use in terms of the sales order review process. And then what we've actually done is we've actually baked, as I mentioned earlier, we've baked a checklist into the sales order management process. So in real time, as soon as the sales order is entered, because we run completely as a cloud-based solution internally, everything's web-based. Okay, what happens is as soon as the sales order is entered, the finance team can basically log in and then review the sales order against the checklist in real time, and then fill out the checklist against the sales order. So we basically kind of customized our ERP to actually do that. We started off actually in terms of the offshoring side of things. We started off with a kind of an offshore kind of third party in terms of the offshore finance team, and then we pulled that in-house, but we still run offshore. So let's just give you a quick screenshot of our kind of QA. So what we're actually looking at here is an actual, we're actually kind of clicking out to our sales order QA. So it's actually inside our CRM system. It's just a kind of screenshot actually from our controller, our kind of controller's view. We can look at a certain sales order, and then you can click in and actually see the QA controls. So here are the various controls we've placed, review controls we've placed on the sales order. And so what happens as soon as it's entered, these items are basically reviewed. Whether it's discounting, the fact that the SOW is being attached to the sales order, all the signature dates, the signatures have been applied, the amount, dates, line items, all listed out in the sales order. So all of that stuff is reviewed by the offshore team, and then they'll basically flag that in a checklist and flag it. So and obviously that's all mapped to the order and mapped through the entire process. So it's an auditable checklist. So one of the things actually that's really helped us internally, as I say, we run everything from our financials all the way through to our CRM. It's all web-based, and so what that's enabled us to do is be a little bit more flexible in terms of where we deploy our finance team. So we don't have to worry about desktop application or people having a hard time kind of logging in and reviewing from a different location. So what that enables us to do is a salesperson in the UK can basically enter a sales order, and then the person in, for example, maybe in Manila, for example, can basically log in at the same time and then review that sales order, all in real time, all off the same system, all web-based. So it enables a very kind of real-time, collaborative review process. So in terms of 0801, so obviously 0801's impact for NetSuite is we've broken subscription and professional services into separate elements for recognition. So what we've actually done is obviously with our professional services, that's recognized on a completely separate schedule, all based on the % of services completion. And then we actually now break out in terms of our income statement. We'll actually break out our services revenue and services profitability and our subscription revenue. We break those out separately on the income statement. And then only for the first year, so this was we adopted last year. For the first year of adoption, we provided comparative data in terms of how our revenue looked under 0021 previously. So one of the advantages, so what we've actually done in terms of our with our ERP system internally, so we're able to basically, we have all of our ERPs. So rather than in spreadsheets, one of the things we realized very quickly is spreadsheets for 0801 it's a very tough proposition in terms of scaling up the business. So all of our ESPs and allocation is centrally managed, rule-based within our ERP system. All of our ESPs are centrally managed, and basically you can report on those. So basically, and also for setting as well, so we can report our actual data to help set the ESPs as well, and all that's all managed in the ESP. So you can slice our actuals by currency, location, sales order size, customer size, all in the ERP, and then also centrally managed, essentially set the ESPs as well. We've actually automated the allocation process. So as we were moving over to 0801, we had the option to restate prior periods or basically restate them kind of prospectively going forward. So we had some flexibility there. And then also because our ESPs and our allocated items are all centrally managed, it makes it much easier to do ongoing monitoring as well. So we're able to do threshold-based reporting and do a variance of the allocated amount versus the ESP amount to flag up any thresholds. So we have alerts and thresholds set around that, so for kind of continual review. So just kind of a quick screenshot of kind of how this looks. We have a kind of a revenue recognition dashboard that our kind of control uses kind of internally, and then we have a kind of allocation price analysis report, and that kind of flags up any kind of any particular allocated items that may kind of fall a wide amount out of the threshold. So another on the kind of control side of things. So another kind of area we've done is with any order that exceeds a certain amount is automatically reviewed by a revenue accountant. So any high dollar amounts or may have high recognition revenue recognition kind of complexity. And then we actually have a meeting twice a month to review any kind of high dollar kind of high amount orders. Also, what we actually do is if there's any amount over a certain threshold, we actually automatically defer all the revenue until it's reviewed. So we have a kind of a highly conservative kind of revenue recognition kind of approach. So over a certain threshold, we'll automatically defer until that's been kind of reviewed by a revenue accountant. And then what we've actually done is kind of interesting. We've actually integrated issue management. So once again, we've kind of customized our ERP solution. So we actually have a case management system kind of plugged into our revenue process. So what you can actually do is you can actually raise a ticket against a sales order, and that will go through an escalation kind of process and a review process and a closeout process. So we have basically a complete kind of a review, and a kind of a escalation process around sales orders, and that tracks the escalation all the way through to completion as well. So it's almost we have an internal kind of support procedure around kind of revenue recognition. In terms of kind of revenue forecasting, so we do a kind of a waterfall, revenue recognition waterfall from all the existing kind of revenue recognition schedules, and then we do that right down in detail, right down to the customer level. So we have actually a very strong accuracy between our kind of actuals and forecasts, and because all of our CRM and kind of forecast data is also in the same system, it makes it very easy also to marry the revenue recognition for waterfall, obviously with also kind of a new business kind of forecast as well. And in addition to kind of running Cloud ERP kind of internally, we also run cloud-based budgeting and planning as well. So we have an automated link between our ERP system and our budgeting and planning and forecasting system as well. So we try to take as many spreadsheets out of the process there. So in addition to the revenue recognition waterfall, we layer on assumptions for new bookings and upsell, and then we place that into our cloud budgeting and forecasting system, and that's all centrally managed too. So we try and drive as many spreadsheets out of the process as possible. So let's have a quick look, kind of a quick screenshot actually of how our revenue recognition report looks kind of internally. So have all of it broken right down by right down to the customer level with the deferred revenue broken out by month. So just kind of a wrap up of what's really worked. As when you're a public company, we've got kind of a rapidly kind of increasing number of sales orders that we're processing. We've moved to 0801. So in terms of what's worked, so sales to finance integration, it's really helped us scale where we have our CRM and our ERP system kind of completely integrated. Makes it much easier for reporting. Makes it much more kind of auditable that you can drill from an invoice back to a sales order. All the information about a customer is all in one single location, from the sales order to the invoice, the revenue recognition. It's all mapped into one single location. Makes it much easier for the reporting process. So the fact that our ERP is, we can customize our ERP, such as case management or writing our kind of sales order checklist. That's really helped us. So we've baked processes into our ERP system. Now, because we run as a cloud-based application kind of internally, when we customize our ERP, our upgrades also move up automatically as well. So it's kind of a big benefit of cloud as your customizations migrate. So our finance team can kind of customize, but also it's okay that when an upgrade occurred, the customizations migrate. So we've automated the review process. We've plugged kind of case management into the review process, and also things such as the controls in terms of high amount revenue automatically deferred. So we kind of automate those processes. And because we're running cloud, web-based, it's enabled us to support a distributed sales team. So we're able to basically put our finance resources, where it most makes sense for us, but everyone is looking at the same kind of data, the same sales order information, the same revenue recognition information, all in real time, no matter where the location. So it's really helped in terms of scale up a distributed kind of sales, finance team, operations team, all that good stuff. So with that, I'm going to hand it back to John.
Fantastic. Thanks, Paul. Really appreciate that. Paul, it's interesting. I think your experience speaks to this, but do you think that a company with a significant volume of SKUs or a significant volume of sales transactions, could they even survive without automating this? Could you survive this process on thousands of spreadsheets?
Yeah, well, I think it's a question of how much risk and how many people you're willing to put into the process, right? I think one of the things that we looked at internally is that the number of people applied to this is going to become prohibitive. The process is going to slow down, as well as the amount of risk it's going to introduce. So I think the short answer is that if you have any kind of aggressive growth plans, it's probably best to get yourself off of spreadsheets for this process as quickly as possible.
Gotcha. And speaking of automation, we're going to go ahead and pop up the second poll question, the final one for today for those taking CPE. Once again, if you're not taking CPE, don't bother. And if you have a moment and you have a question, please feel free to pop it into the question panel on your GoToWebinar control panel, and we will get into asking those in just about another 10 seconds here. So please feel free to ask some questions, and we'll go to Aaron and Paul. All right, I'm going to go ahead and close down the poll at this point. Thank you. All right, next let's go ahead and jump into the Q&A. And one for Aaron here, for starters. Given the work on the new proposed standards between the FASB and the ISB, when do you now think the U.S. Might commit to adoption of IFRS? These things seem wrapped up in one another. Do you have any visibility into that or thoughts?
Yeah, I do. So it's, I mean, it's a great question. It's kind of a, it's a bit of a long answer, but to kind of summarize, I guess. So the FASB and the ISB's convergence efforts, which are broader than just revenue, they cover other projects such as leases and financial instruments and so forth. That is a key precursor to the, and the SEC is actively monitoring the progress of those projects as it gets down the road here of making a decision as to whether, when, and probably how IFRS would be incorporated into the U.S. reporting environment. You know, suffice it to say, we are expecting, or we've been told by the SEC that there should be a decision this year in 2012. You know, the SEC is soliciting input. Actually, PwC and its IFRS and Convergence website has actually undertaken a survey to ask people, ask companies, and you know, preparers, you know, what they think. You know, we as to whether or not and how the U.S. will eventually get there. That's what we're looking to hear from the SEC here sometime this year. You know, the latest idea that was floated earlier this year in a staff paper from the SEC has, you know, this idea of condorsement. It's an entirely new word that the SEC has just made up as kind of floating a possible way that the U.S. may incorporate IFRS. I think, you know, nobody can say with any certainty that they know what's going to happen at this point. And you know, I think we're looking to kind of see what, you know, take the temperature of the environment and see what we you know, what makes the most sense. And I think what we, you know, one of the things that we can say with certainty is that, you know, there was a time a couple years ago where the SEC was contemplating a big bang switch where we would, you know, pick a date and we would turn off the lights on US GAAP and turn on the lights on full IFRS. We are no longer in that kind of a model today, and what the SEC has recently floated in their staff paper is more of a gradual approach that would, you know, take place over potentially 5 to 7 years. You know, it would start with convergence. We would see revenue, leases, financial instruments drip through here in, you know, 2014, 2015, 2016. After that, then IFRS standards would be kind of prioritized, and we would see a drip through of IFRS potentially into and incorporated into US GAAP. You know, the FASB may, you know, remain as kind of the gatekeeper of how that would happen with the SEC, with SEC oversight. You know, how does that happen? What is the FASB's role in a US IFRS world? How does the SEC regulate that kind of an environment? And, you know, does that, in particular, does the SEC continue to issue staff pronouncements and so forth? You know, that's all part of what, you know, we're looking to see over the next little bit here. You know, I think there is, you know, one of the knowns is that, you know, the convergence between IFRS and US GAAP is going to be one of the drivers of an unprecedented level of change under US GAAP, you know, now and into the next couple of years. You know, how does the US adopt IFRS? How do we incorporate IFRS? You know, if and when and probably how, you know, are the big questions that are remaining to be answered here, hopefully in the not too distant future.
Got you. Well, if they have to go about creating words like condorsement, I think we're all in trouble.
It's clearly a subject of debate that, and you know, there's surveys out there. You know, I encourage folks who are, you know, companies who are interested in following this to, you know, to look up these surveys and engage in the debate, because it's something that the SEC is asking questions about right now.
Okay, great. Thank you for that. Paul, when you guys were going through your changeover to 081, how important was it for the accounting and finance organizations to work with the sales organization, maybe the legal organization? It seems like there are a lot of changes that are required to sort of the practices of people selling, because OA1 actually makes it easier in some ways for folks to have a variety of different things they can do, like discounting and offer different prices for post-sales support than they used to. So how much, how much work in between organizations did your company do, and how critical was that to the success of the program?
Yeah, I mean, we had to work closely with the sales team as well as the services organization as well. But because we were, obviously, prior to 0801, we spread everything over we recognized everything over the term of the contract. Software, plus services. As soon as we moved to a percent complete model for breaking out services on the rev rec schedule, we had to work closely with the services team to make sure all that percent complete information was managed and then pushed into the finance system. So what we actually do, because our professional services automation solution is basically tightly integrated with our ERP solution to make that percent complete push much easier. Then in terms of the sales side of things, yeah, you're right. I mean, one of the things that we said, obviously closely track is sales discounting, and also to make sure that the ESPs are accurately reflected. So once again, it helps the estimates the sales guys are providing with their quotes and the estimating selling prices that we have in place. We don't have the estimated selling prices in the spreadsheet and and the CRM in Salesforce.com, for example. We don't have that. We have it in one single location, so it makes it much easier to take the ESP and take a sales quote, for example, and make sure that there's a reasonably close mapping between those two, and raise the threshold. So we actually do a level of reporting on that as well.
Gotcha.
But
right.
Yeah, it's really important to look at it. One of the things that 0801 really does is it makes it important for the finance system to be very closely tied to other systems within the business, whether it's sales system, support system, project system. That stuff to me is to be much more closely integrated to avoid a kind of a spreadsheet-based situation.
Right. Aaron, another question to you. 97.2 is still in effect for essential software services. Is that correct? And therefore, is the residual method still used for sales of essential software, as long as it hasn't been split out via 081 or 093?
Okay, yeah, let me answer that in two ways. So as far as what the effect of 093 was to require that software that is essential to the functionality of the hardware, that combined group not be accounted for under 97.2. So if you're selling hardware with software, the only thing that you're applying 97.2 to is the only thing that you're applying the software rules to are the pieces of software that are not essential to the functionality of the hardware. And so that's optional software. If the hardware is sold, is really ever sold without a piece of software, then that software cannot be said to be essential to the functionality of the hardware. And that software must be accounted for under 97.2. So as far as, going back to that slide that looked like, had a bunch of trees and branches on it that I was looking, that I was talking to earlier, if you are selling, going back to the iPhone example, right? The iPhone comes with an operating system, email, a web browser, and other software that is always included on that iPhone. And so Apple would look at that and say, well, that software is essential to the functionality of the iPhone, and so it's not a software deliverable. It's all scoped into 081. It's scoped out of the provisions of 97.2. applications and other optional pieces of software may not always be sold with the iPhone, and so that it is included on the iPhone, that piece, the optional software, would need to be scoped into 97.2.
Gotcha. And just to hit one final question really quickly, Aaron, are there any changes to gross versus net revenue recognition if you're selling a product as a sales agent, like a third-party sales agent, or are there any changes to revenue for folks selling as agents?
Not as a result of those two accounting standards. They did not affect
Gotcha.
versus net. Now, the forthcoming revenue proposal, the gross versus net, this joint project that I was speaking to earlier, the FASB and the ISB have basically taken the U.S. GAAP provisions. So there has not recently been any changes to that, and under the proposed exposure draft, we wouldn't expect to see any changes there either.
Gotcha. Great. Wonderful. Okay, let's do a little bit of last-minute housekeeping here, and then we'll let everyone go. First off, thank you so much to both Aaron Victorino of PricewaterhouseCoopers and Paul Turner of NetSuite for your time and insight. That was a great hour, and I think we all learned a lot from that, so thanks to you. Thanks to Host Analytics, PwC, and NetSuite for sponsoring this event. And that allows us to offer this event for free to all of our users, and we appreciate that. We certainly thank the audience for your time and attention this morning. We know how busy we all are these days, so we greatly appreciate your coming and taking an hour with us. We will send you a follow-up survey. We appreciate your feedback. We'd like to know what we could do better the next time around. On that survey form, we make it very simple for you to ask to reach out and be connected to the speakers at today's event. So please feel free, if you'd like to connect with either Aaron or Paul, just let us know on that form, and we're happy to make that connection for you. We will be sending out also, I think as part of that email, a link to a soft copy of the presentation, which you can just download for free. If you have any questions about CPE credits, please send an email to WALSH, that's T Walsh @proformative.com, and that gets you to Tanya Walsh, who manages our CPE certificate program. Please feel free to direct any questions to her. She'll make sure you get taken care of. That's it. I'd like to thank everyone for your time and attention. Have a great rest of your week, and we look forward to seeing you either online or at our next Proformative event. Thank you all, and we bid you a pleasant day.